I'm Money with Mark, and this is everything you need to know about the brand new First Home Savings Account for Canadians. The First Home Savings Account is called the FHSA, and it combines the best of the TFSA and RRSP all into one awesome account. It's specifically designed for Canadians that want to save for their down payment on their first home. It allows you to contribute up to $8,000 per year, up to a maximum of $40,000 total. And you can then take that money and invest it in low-cost index funds within your FHSA account. And if you're sitting there saying, I can't even save the money, let alone use this account, then you might want to start tracking your cash flow. And I have a free Google Sheets cash flow template that you can use down below in the description. It's a semi-automated cash flow tracker that allows you to make sure that you're spending less money than you earn so you can save money into your FHSA account without all the headaches that come with traditional budgeting. So if you like the sounds of that, then you might want to hit the like button on this video and subscribe to Money with Mark, because here we are all about working less and living more and using our money as a tool to do so. To determine if you're eligible for the FHSA account, you need to be 18 years old and you need to be at least in Canada. You do not need to be a resident at the time that you open your FHSA account. And if you're still not a resident when you withdraw your money from your account, you will be taxed on it, but it's at least tax deferred. So this is an awesome account for non-residents in Canada to use. If you really want to know if you're eligible for the FHSA account, download my decision matrix below, which gives you all of the exact details on if you are eligible for this account or not. It's free to use, so just download it now. You can open your FHSA account by applying at any of the big banks, but if you are a Money with Mark subscriber, you know that I actually do not like investing our money with the big banks because they will charge you $10 per time that you trade or buy or sell low-cost index funds in your FHSA account, TFSA, etc. So what I recommend is some of the new fintech companies in Canada, and right now Questrade is the company that has an FHSA account available, and they have much lower commissions and charges and fees than any of the big banks do. So if you want to sign up for your FHSA account, go sign up with Questrade. You see the link down below. Once you have your tax-free First Home Savings account open, you can start to put money into it and buy low-cost index funds to invest your money. And as you do that, after the end of the calendar year, you are going to submit on your tax returns how much money you put into your FHSA account. And that is a good thing, because then you are going to get a tax credit back for all of the money that you contributed to that account. Basically, the government's gonna say, any money you put in here, we're not gonna count it as income from you, which is why you get that money back. And when it comes time to actually withdraw the money out of your first time tax-free home savings account, you will actually not have to pay any tax on any of your investment gains. That's a huge advantage with this account. You literally get all of that money from your FHSA, and you can just put it directly on your down payment for your house, no strings attached. But there is a few critical details you need to know about the First Home Savings account. The first being that if you have not withdrawn this money and used it for a home purchase within 15 years, or by the time you turn 71, then you will be forced to transfer those investments into your RRSP or an RIF. Or you'll be forced to withdraw that money on a taxable basis like an RSP. There are annual contribution limits of $8,000 with a total lifetime of $40,000 contribution. The home that you purchase must be located in Canada, and cooperatives are not allowed, which means condo purchases are not included as an eligible home with the FHSA account. You can do non-qualified withdrawals, but it will be taxed as taxable income. However, this does give you a potential good opportunity if you end up not using it. For example, if you are a single woman right now, you start to save in your FHSA account and you eventually get married and have a partner who already owns a home, you would no longer be allowed to use this account, or at least contribute to it. But when you go on maternity leave, you could pull your money out of this account where you have a lower taxable income in that year that you're on maternity leave and get that at a much lower tax rate. So it's still an account that you should take advantage of, simply because of the tax deferred income and investments that you can have. You might be confused in Canada because there's an RRSP, a TFSA, and now the new FHSA. So what account do you use and when do you use it? If you want to see a full matrix to know what the pros and cons are of each account and compare them side by side, then click the link down below to go to my website where I have a full breakdown for you and to show you which account you should start saving in first based on your personal situation. So what do you think? Are you going to open up a first home savings account? Let me know down in the comments below. And be sure that if you are going to open that up, then use my link below for Questrade. It helps support this channel, and I will see you in the next episode. Peace out.